Welcome back to the Final Bar, first one of the new year. Happy to be back with you. Today on the show, we're going to open up the Final Bar Mailbag, answer some of your questions from over the holiday break. In a segment called Sector Setups, we're going to talk about the rotation of the 11 economic sectors around the S&P 500 and which sectors you need to be familiar with. Then our very popular mystery chart segment. Ladies and gentlemen, this is the Final Bar. Hey guys, welcome to today's edition of the Final Bar. It's so good to be back live with you after the holiday break. Hope everyone had a wonderful holiday season. Happy New Year to all of you. We've talked a lot over the break about how we can make this show better, how we can improve StockCharts TV, and we're excited to start doing more and more for you, help you illuminate the market activity and what charts you need to be familiar with. On today's show, we're going to sort of regroup on what we've seen. Obviously, a continued push to new highs, but a stalling of sorts with sell-off into today's close. We're going to talk about what that means for the long-term charts, where some of the key stocks are at. As we talk about sector setups, one of the segments we added today in particular was sector setups, thinking about sector rotation, because you have things like healthcare and technology, which have been sort of high-flying leadership and some weakness potentially in the healthcare sector. And if that sort of follows through, that's where you might get a little bit of distribution going here in the month of January. Also a focus on the financial sector. Stocks like Goldman Sachs looking okay. Stocks like JP Morgan maybe breaking down a bit. So thinking about those relationships, I think will be really key for everyone in this first month of the year. And this first month, January, is all about, do we see a follow-through? Do we see a resumption, a step on the gas? Or do we take a bit of a pause? And we'll try to answer those questions with charts here today. Let's get to the market recap. So, obviously the trend has been positive since we've been live, which is sort of the last couple weeks here. We've seen this significant uptrend, and pretty much from the moment we stopped doing a live show, we sort of stalled a little bit, and we've had a bit of choppiness, right? A bit of added volatility. You can see just how the price bars have evolved from a slow and steady uptrend to more of a choppy up and down trend. Now, most of the bars here, if you'll notice, have closed near the highs of the day, or definitely closed above the open. And I think it tells you a little bit about the short-term environment. When there has been selling, there's been accumulation. It's been met by demand, and that's what causes these bars to look like they did. But you can see we really haven't had a significant upside follow through. Today was a little bit of a digestion of yesterday's gains. You see the big up day yesterday. Today, a little bit of a distribution. A lot of that came really in the last 30 to 40 minutes when things started to sell off a little bit. We talked a lot last year, the end of last year, about this potential bearish divergence or non-confirmation with higher highs in the price, lower peaks in something like RSI, a measure of momentum. And I think that is the question that we'll be trying to answer over the next week or two, is whether or not this is an indication of an exhaustion of demand, an exhaustion of buying pressure, a little bit of corrective patterns, a little bit of pullback to the 50-day, or if this is just a pause before another leg higher. And looking for something like the S&P, but also stocks like Apple, Microsoft, if they're able to hold up well and continue to push to new highs, that's what's going to drive something like the S&P 500 further up. So again, I mentioned the last 30 minutes of trading. This is what the last hour looked like. You can see this looks very similar actually to last Friday. We had a lot of distribution going into the close. And this is after a lot of days we had a ton of buying right into the close, which shows you a sort of a capitulation of sorts, right? A lot of institutions stepping on the gas, but this a little different, this feeling a little choppy in the last couple of days. So we'll have to see again how this finishes off, but today really not confirming much of the upside that we've seen. I want to go to the Mindful Investor chart list, and if you've not seen this before, if you go to my blog page, The Mindful Investor, you see a link to go to this chart list. You can click here to save it to your own login. I'd make a point of doing that. I just wanted to point out that breadth overall remains fairly positive. So, one of the conditions or one of the, I think, validations of further upside is the fact that you have strong breadth. Now, the last couple weeks are just this little bit of the edge on the far right side of the chart. It's not really going straight up like it had in October, November. It's sort of holding off a little bit. And even if you look at mid cap and small cap breadth, starting to turn down a little bit. But again, it's still early on. As long as those lines remain positive, that tells you overall that the breadth has remained pretty strong. The chart I did want to point out was this one. This is looking at the ratio of consumer discretionary versus staples. We're going to talk about sector setups later in the show today, and we're going to look at these two consumer sectors in particular. But I want you to note the fact that this ratio has now started to break higher. So this had been in a downtrend for quite a while as consumer staples had been outperforming consumer discretionary. We've now seen the tables turn there, and we've seen this ratio go higher. What's interesting is the equal weighted ratio of the equal weighted consumer discretionary versus staples sort of flat. So not really confirming that breakout, right? So again, this is a big weight on the biggest names in consumer, especially something like Amazon, which is a huge weight in the XLY, is pushing this higher. But overall, on an equal weighted basis, they're sort of even. There are good bets to be made on both sides of that. So that's sort of what we're seeing here. I also want to go a little further down the chart list to show you growth versus value. So this is the Russell 1000 growth versus Russell 1000 value ETFs. You can see how this ratio has gone to a new high in the last couple days. This is significant because when this ratio came down, a lot of people are starting to say this is the return of value. The growth trade is over. The whole feel of the market, myself included, you saw this change in configuration. And if value starts to outperform, that's something a lot of people are not prepared for. But look at how that has reversed. In the month of December into the first week here, in January into the second week, starting to see a real rotation higher back into growth names. If you look at it, the pure growth versus pure value, so this sort of takes two separate buckets of growth names versus value names. That ratio is back above its 200-day moving average, also breaking to new swing highs for the last couple months. So overall, seeing a move back into growth in the last couple weeks, that's sort of how the market has felt, and that's what the charts are sort of validating. Let's finish off this market recap by looking at the member dashboard page. And again, this looked very different an hour ago when we started preparing for the show. You can see how things sort of distributed into the close. The S&P down almost 1/3%. The Dow Industrial down a little bit more. Small caps down the most, over 0.5%, about 0.56%, excuse me. So small caps leading the way lower, with mid caps sort of the strongest of the three, but all down. On a sector basis, communication services, the only sector out of the 11 that finished in the positive. Real estate, consumer staples, and financials leading the way down. Interesting to see healthcare down here. Healthcare has been one of the stronger sectors on a relative basis and starting to see a little bit of a weakness today. Interesting that while energy was one of the weaker places, a lot of energy names breaking down. You can see something like Noble Energy down here on the weaker names list, the down scooter rankings. Apache was up. This is on news from Total, which is a Brazilian energy company. You can see a different look there. So it's diverging a bit from certainly some of the other E&P names in the space. Also had Macy's, and this is a stock that's been one of the most chart-challenged names. This part of consumer discretionary, sort of the broadline retailer space, has been pretty rough. But look at how December really changed the picture there. Now it's broken to new 3-4 month highs, filling the gap almost from back in August when it sold off, and now starting to test the 200-day. So and reaching an overbought condition. So a real change of configuration from something like Macy's, which is actually really interesting to see. Just one more to highlight. I did want to point out in healthcare, you've got some potential chart issues, and Merck is one breakdown that sort of jumped out at me. Just breaking below the most recent swing low, so still early days, but if this is the beginning of further distribution coming off of this overbought condition, again, that's a little bit of a weaker look than we've seen from healthcare, which have been some of the stronger names that are out there. So that's our quick market recap for the day. And again, the market recap, boy, we could spend an hour just on some of these charts in here. I'd encourage you to look down through the member dashboard, focus on China, where we've seen some nice charts start to emerge, and some of the Chinese ETFs as well. Our next segment, however, is looking at the Final Bar Mailbag. As you know, one of my favorite segments is answering your questions. Before we get that, though, thank you, Producer Gretchen. The mystery chart. Sorry about that. First day back, we'll have a bit of a jitter here. This is our mystery chart for the day. Sorry, guys. I'll get better. The mystery chart for the day, the question is, what is this chart? This is also my favorite. They're all my favorite segment. This is a good one. Looking at, this is an individual stock. This is a stock just breaking to new 2-month highs, testing 3-month highs. We had a breakdown in October, and now it's back above the 200-day moving average. What is this stock? And it's the price on a daily chart, the RSI, and the relative strength at the bottom. If you have a guess, please guess for us. Put it in the chat room on the Q&A page, and we're going to take a look. And later in the show, we'll unveil what this is and answer some questions, talk about why it's an important chart to get to. Now, folks, let's rotate to the Final Bar Mailbag. Again, I love answering your questions. And again, the best way to get questions to us is via email. thefinalbar@stockcharts.com. We'll review all of your questions. We read everything and talk about how we can incorporate them into the show. Also encourage you to put questions in the Q&A during the show. We take all of those and incorporate them into the mailbag sections as well. The first question actually dealt with more feedback about the product. Someone wrote some really thoughtful questions, and again, I'd encourage feedback on StockCharts.com, on StockCharts TV, whatever, and I'll make sure it gets in front of the right people here. But the question was about scanning. How can we improve the scan engine, get more data? About backtesting. How can we backtest technical ideas over time? And the answer to those two is we're working on it. We actually just are completing our 2020 game plan, thinking about how we can improve the product. There are so many cool things coming from StockCharts.com. I'm sure we'll have Grayson Rose, maybe Bill Shelby, some others from the development team here over the course of the year to share with you some of the latest features. But those are two in particular. We're actually looking to rebuild the scanning engine, incorporating backtesting, incorporating some of the feedback that many of you have sent. So if you have any particular things you'd like us to include, I'd love for you to send us those questions as well. The second was on fundamental data. We have very limited fundamental data, so when you're looking at a particular stock, if you bring up the full quote line, you'll get some basic information about dividends. We'll have some information about the stock, the PE, the earnings, and so forth, but not a ton yet. And the answer there is coming soon. So we're actually working on a much more comprehensive fundamental data experience on StockCharts, incorporating earnings dates, incorporating some fundamental ratios, valuations, looking at analyst data, all of those things that you've been asking for. Again, once we have some things ready, including, just as a teaser, a new stock summary page, a simple summary page where I actually show you all the relevant fundamental and technical data for a particular company. It's coming soon. We're working on it, sort of testing it internally. As soon as we can get it to you, we certainly will, and I know we'll feature it on the show. So thank for the product feedback and those particular questions. I'll write you back, the person that wrote in. Thanks again for that with some additional thoughts, but please keep feedback coming. And again, we're looking to make the product better and happy to use your feedback as the main catalyst there. The second question I wanted to address was on the S&P 500 $SPX versus the S&P ETF, the SPDRs, SPY, and how the two of them are different. In particular, it's talking about performance charts. So I'm in the perf chart section. So if you're not familiar with this, click on Sharp Chart, switch to perf chart, start typing tickers, and you'll get to this page, and you can add additional tickers. You can look at it in different views to show how these things are related. But here you're looking at the S&P 500 over the last 200 days. You're also looking at the SPDRs for the last 200 days. You can right-click and look at a different segment. So for example, the past year. So now we're looking back to January of 2019. Why are these lines different, right? So you're showing the S&P 500 up about 28%. You're showing the SPDRs up 31%. Aren't those the same thing? And the answer is yes and no, right? So the SPDRs, the SPY is including total return. So it's including dividends as part of the performance calculation. That's why that's a little higher. The $SPX does not include dividends. So this is important when you start to look at ratios. So when I'm looking at a chart of Home Depot, you can see that I always do my relative strength look relative to the SPY because I'm looking at the stock including dividends, so I want to use the benchmark that includes dividends as well. If I would look at the $SPX down here, I would be taking the dividend component out of the denominator, and the relative strength is not going to, it's actually going to look a little different because I'm not incorporating them. So on the perf charts, it's very important, and my suggestion to you is to look at what types of tickers you're looking at. If you're looking at the regular tickers, you want to line it up to the SPY because that's going to include dividends there as well. If you are looking at a stock, so for example, if I do underscore HD or if I do underscore lows, these are actually taking the dividends out. It's just on a pure price return basis. In that case, you want to take out the SPDRs because you want to look at it relative to a price-based SPX. So it's all about how you want to look at it. There are different ways to do it, but that's the main difference between those two. The final question was about mean reversion versus trend following. And I just want to spend our last minute answering this question. I actually did a webcast as part of the Market Vision 2020 event. I'd encourage you to look at the Earnings Beats website, earningsbeats.com. So you can see information about the event that just happened and find a way to access some of the replays there. I did a segment called The 3 Timeframes of Technical Analysis, and one of the slides I used was this one. And essentially I've talked about this in different ways, but I just wanted to highlight very quickly. If your investment window is a couple days to a couple weeks, sort of a short-term environment, the markets tend to mean revert, meaning in general, you're better off buying weakness and selling strength. In a medium-term time frame, if you're looking at a couple months to a couple years, the sort of the sweet spot for technical analysis, in my opinion, you should be a trend follower. You should be buying strength and selling weakness because that's what has tended to work. If you're a long-term investor going many years, you're a long-term investor, then you're getting more into the business cycle, more about the long-term cyclical nature of sectors and themes coming in and out of favor, and the market goes back to a mean reversion segment. So mean reversion performance. So depending on what your time frame is, if you're short-term, a couple days, couple weeks, more of a swing trader, or if you're a medium-term investor, a couple months to a couple years, the way that the data supports is very different. So it tends to mean revert in the short term, tends to be more trend following in the medium term. That's a really good question. That's just a teaser into how to think about it. Going forward in the coming weeks, hopefully we'll do another segment where we can dig a little deeper into this, and I'll show you some examples of how those timeframes work and why you want to think about trend following versus the short-term mean reversion that's pretty common in the market. So thanks very much for the question there. Really appreciate it. We're going to take a quick commercial break. When we come back, we'll do a segment on sector setups, thinking about sector rotation. You're not going to want to miss it. See you back in 30 seconds. Welcome back to our show, The Final Bar. We're with you every weekday, 4 o'clock Eastern, 1 o'clock Pacific, to look at the short-term movements in the market, connect it to the long-term trends, put things in proper long-term perspective for you. So thanks for joining us today and every day on StockCharts TV. Let's get to our next segment called Sector Setups. This is one of my favorite things to do because we're using the relative rotation graphs to look at the rotation of the 11 S&P sectors versus the S&P 500, but also we're starting to look at some of the 11 sectors on a price basis. There's some really interesting themes that have emerged recently based on some of the relative rotation movements. So this is a look we've brought up a number of times on the show. And again, if you're not familiar with the RRG, we don't have time to really get into the details here, but I encourage you to look at the sector show of my colleague Julius de Kempener. He's done a really good job with his show on sector rotation. You can also look at our YouTube channel for StockCharts.com. You'll see all of his previous shows. He does a great job of breaking down how to include this into your thinking about sectors and other asset rotation. When we're looking at the 11 S&P sectors, you can see this general clockwise rotation, and there are a couple things that I want to pick out for you. Number one, healthcare has been leadership. Technology has been leadership. They've rotated here to the upper right. I'm going to put the chart in motion, kind of rewind, and now take it back to today so you can see how they're really rotating into a position of strength. The XLV just rotating down to the right a little bit because of some of the breakdowns and things like Merck that we highlighted earlier. But look at how financials have really weakened relative to these other ones. So while the XLK technology has held up just fine, healthcare overall doing okay, look at how financials have rotated down and to the left. And Southwest is the real direction of pain. That's showing you a weakening of momentum, a weakening of the relative performance. And that's where we're starting to see financials sort of stalled out. And while the S&P is holding up okay, the XLF really rotating lower on a relative basis, especially. Also now I want to draw your attention to the XLI. This is industrials. Look, as we move over the last sort of 2 months, you can see how this has rotated down and to the left now in the weakening quadrant, getting to the lagging quadrant. It's very close to the benchmark though, and in general, things very close to the benchmark really aren't moving in a big way relative to the benchmark movement. So it's not really creating a ton of pain for you if it's moving down. But if you're there, you might want to reconsider how you're thinking of it. Look at how energy in the upper left is one of the only sectors in the improving quadrant, has again, after coming back toward the end of last year, now started rotating back northeast, which is kind of where you want things to go. It'll be interesting if that continues higher. Again, that's something that I think so many investors are unprepared for energy to do well. The next thing I want to point out are the XLY and XLP. These are our two consumer sectors. Look at how these rotate. These were really up and to the right. You can see how they rotated down into the left into the lagging quadrant. Now you can see that the XLP, still lower, but the momentum is waning by the fact that it's coming up. See how the XLY has turned much more suddenly. That's why that ratio of consumer discretionary to consumer staples has improved so quickly. You're seeing a lot of improvement in parts of consumer discretionary, starting to make that look a little more attractive. Utilities and real estate, really the weakest sectors out of the 11, starting to rotate a little bit stronger, but nowhere near the point based on that long-term weekly view that tells you want to be there necessarily yet. Let's look at some of the individual charts. I want to start looking at healthcare, and as I mentioned, some charts in there starting to look a little weaker. You see some breakdown in some of the pharma names, which you'd want to pay attention to. This is pulled back a little more than the broader market. You can see how the relative strength has come off a little bit, but overall still just fine. So again, the RRG is based on relative strength. So when you see that rotate lower, it's going to affect its relative rotation relative to the other 10 sectors. But overall, on a price basis, still holding up pretty well and very far away from an upward sloping 50 days. So overall still fine, but it's one that you want to pay attention to. The one that I do want to highlight though instead of that is the XLP. This is consumer staples. So look at how the XLP rallied in November and December, pulled back the last week of the year and has followed through to the downside, making a new swing low again today, approaching the 50-day where it's found support a number of times on the way up, but this is where it's really painful. Look at the relative strength and how on a relative basis, we're at new 6-month lows actually, right? So while consumer discretionary has held up just fine, staples have really started to underperform. So you really want to think more of a stock picker in that particular sector. An allocation there may not make sense because of the relative weakness, but looking for particular opportunities is how you want to generally think of it when that's the overall signal. This is the XLE, and again, on a price basis, doesn't look too bad. You're starting to see a potential rotation from distribution to accumulation. The problem is the relative strength really hasn't improved a whole lot because you have things like tech and healthcare and consumer discretionary and industrials that are all holding up really well. So while this is improving, it's not improving anywhere near on a relative basis where it would suggest you want to start to be there. But look at how the relative strength potentially starting to turn if we see follow through over the next couple weeks, and that's where I would suggest that the XLE should be on your mental watch list. See if you start to break to new 3-month highs, which we're testing from the peak in September. See if we're able to test some previous resistance levels. See if the relative strength is able to break above potentially a new 3-month high, potentially from above the high from September. That would tell you that you're really seeing the upside follow through on a relative basis. That would tell you might want to be here. But I would tell you the last things to point out. Technology continues to lead on a relative basis, holding up very nicely. There's not much in that chart to be too disappointed at. Financials, I think, are the one you want to worry about. If I draw a trend line, taking the lows from October and December, you can see we're just starting to break that in the last day or two. If we would break down through that, follow through on that breakdown of trend line support, that would be a concern. But on a relative basis, look at how we're now to a new 2-month low, potentially a new 3-month low as we near this point from mid-October. If we start to see a follow through there, a breakdown in some of the relative strength, I think that would be a concern. And that's coming from some of the main names, right? You start to have some dispersion within financial. So this is Goldman Sachs. Excuse me, one of the larger banks. You can see how this is at new 3-month highs in relative strength, but compare that to something like JP Morgan, starting to break down a little bit in price, the relative strength starting to turn down a little bit, coming out of what had been overbought for a 2.5-month period. So if we start to see more stocks look like JP Morgan than Goldman Sachs, the XLF is going to certainly go lower and follow through to the downside, start to test support. So the XLF, I'd finish off in terms of the sector setups. One of the ones to pay attention to, if that's weak, again, that would maybe give you some implications for the broader S&P 500. That's our segment on sector setups. Do you know what the mystery chart is? Again, my only hint to you, this is an individual stock. So any guesses? Netflix, guess number 1. Incorrect, but thank you. Second guess was McDonald's. Couple for McDonald's. Final Bar Nation, well done as always, and you're absolutely correct. McDonald's is the chart. Let's bring up the actual chart of McDonald's here, just so we can see some of the relevant data on here. You know, it's interesting. One of my, one of the chart packs that I review regularly are the Dow 30 names, just looking at those. And again, not that the Dow is the best benchmark, I would argue it's one of the worst benchmarks to use because it's not a great slice of the overall equity environment in the US. But There are 30 names that if I am familiar with them, I'm feeling pretty good about a sense of different sectors and certainly the large mega cap sort of trade and what those largest names are doing. McDonald's has certainly rotated. If you go back to October, this is one of the ugliest charts out there, and out of the Dow names, probably one of the weaker ones, right? You'd broken down through the 50-day, you'd broken down through the 200-day moving average, testing new lows, testing a new 6-month low. The relative strength was in the tank. I mean, just completely going down. It's oversold when so many stocks are nowhere near that. But look at how this has slowly and steadily improved from that low the first week in November. Seen since that moment a pattern of higher highs and higher lows. We've reclaimed the 50-day. Now today followed through and reclaimed the 200-day moving average back above it, nearing the overbought region, which is kind of what you want to see. If the stock's going to recover, it better become overbought as demand starts to come in that. The relative strength is still pretty muted, but it's testing a new 2-month high in relative strength, starting to go to new peaks, testing this resistance from November and December. So McDonald's is a name that I think a lot of people had agreed to not be there because of the weakness, but I would point out stocks like this that have rotated. You have so many stocks like Microsoft, Apple that come to mind that are just sort of long and strong up and to the right, have just been consistent long-term outperformers. Those are great charts to look at. But I'm more interested in charts like this where you're seeing rotation. You're seeing a change in perspective, or a change in perspective from more fear-driven to more greed-driven, or more bullish sentiment, more accumulation over distribution. And this final move back above the 200-day for the first time since mid-October, I think, is very telling you that people are starting to rotate there. The relative strength starting to improve. When the S&P 500 is not breaking to new highs, you have something like McDonald's that's breaking through new swing highs. So well guessed, Team Final Bar. Appreciate your guesses as always. Well done. You're absolutely right. McDonald's is the chart. And again, if you're not familiar with what charts like that look like, part of my normal daily routine is to look at this candle glance page of the 30 Dow components. It's a great way to just check on some of the largest names out there, and I'd encourage you to set something like up to pay attention with it. But folks, we are nearing the end of the show, and that means it's the time for the 3 in 3, 3 charts in 3 minutes. These are charts that should be on your radar if they're not already. We're going to start with one of the stocks that I think you want to be familiar with. I mentioned just moments ago about Microsoft and Amazon, or Microsoft and Apple being just consistent outperformers. And the chart of Microsoft is one that I'm going to highlight here. Down almost 1% today, so underperformed today. You can see the relative strength took a bit of a hit so far year to date, but overall, look at how the relative strength is so strong. It's up 23.5% on the S&P over the last year. And again, after just making that great point about doing relative to the S&PY, I have the wrong benchmark, so I'll change that. But overall, performing very, very well on a relative basis. You can see it's been testing new price highs, a new price high going into the new year. So if a chart like this continues to make new highs and new lows, you have to feel pretty good about the overall market environment. What concerns me about a chart of Microsoft is the same thing that concerns me with Apple and with Disney and with the XLV and so many other places, is this non-confirmation, the higher highs where we've seen a lower peak in RSI. It's now starting to come down a little bit. And again, that could be the beginning of a bit of a more weaker January as people digest what was an incredible fourth quarter going into the end of the year. So that is one of the charts that I'm going to be focused on to see if we get some sort of corrective pattern. The second chart of the 3 in 3 is the XLF. During our sector setup segment today, we talked a lot about the 11 S&P sectors, what some of the themes are, and I think financials are a really interesting one to look at because you see this 2-year base that the XLF has broken out of. We talked a lot about this in November and December, breaking to new highs, testing support, and now going up. But now we have a bit of a stall, right? And if we continue the uptrend or if we pull back, the direction of the XLF, I think, could be really telling about the health of the overall equity market. In particular, this is a sector that's been performing really well in the fourth quarter until mid-December, and now the relative strength starting to weaken. So I'd pay attention to that one, folks. And then the third one is consumer discretionary versus consumer staples. We looked at this at the beginning of the show in our market recap, and talked about how this ratio of consumer discretionary versus consumer staples has rotated, and after favoring staples for about 6 months, has now started to favor consumer discretionary. That's a very different look. Now, on an equal weighted basis, though, they're very much in lockstep between the two. So what this tells you is there are some big names causing this ratio to improve. If Amazon does well, that ratio is most likely going to go up because it's such a big weight in the XLY. But looking at that equal weighted measure tells you that overall there's strength in both sides. There's weakness in both sides. It's a great time to be a stock picker in the consumer space. I'd encourage you to use your screening tool as well to come up with some ideas there. Ladies and gentlemen, that's our show, The Final Bar, for a Tuesday afternoon. Thanks so much for joining us. Please keep your feedback and your questions coming. We'll get to them in an upcoming mailbag segment. The Final Bar at StockCharts.com. Also, check out our YouTube channel for StockCharts.com for all our previous shows. For StockCharts.com, I'm Dave Keller. Have a great night.